Hi, welcome back everyone. I'm Tracy Krepper and this is another edition of Credit Conversations. I'm here today with Craig Lupton, the head of our Consumer Data Insights, to talk about the consumer credit market at the start of 2024. Craig, if you would, give us an overview of what we've seen so far. What are we seeing as the indicators of what's happening in the consumer credit market?
It's been, what I can say, a roller coaster for consumers over the course of the last 3 or 4 years. We've had the COVID pandemic, we've had the cost of living crisis. So really consumers have been in a position to be able to spend, not spend, and then spending more on the purchase they're making. So it's been quite turbulent for them as they've made their way through, and that's been impacted in terms of the credit markets that we see on there. Consumers are paying more for their unsecured credit, they're paying more for their mortgages with their base rates rising, and this is across the entirety of the UK, so it's not just confined to certain sectors, particularly when we've seen some pressures in the southeast and across both younger and older household groups as well.
Sounds like there's actually a real opportunity for growth.
Yeah, absolutely. So, I mean, we've had a number of positive indicators for consumers at the minute. So we've had energy bills start to fall, so people are starting to feel better in their pocket compared to last year on the energy side. Income is continuing to grow for consumers, and inflation, which has been having an impact on that real wage growth, is obviously coming back down as well. We're nowhere near the peak that we were at previously. Unemployment also has maintained at a steady level, so people are still in work, so people are still getting paid, which means it gives them the ability to go out and spend, borrow, and afford their credit on there. So yeah, absolutely. The consumers are looking more positive, there's confidence in the market, and there is appetite from consumers coming back into the credit markets.
So from a lender perspective, what does that mean from demand in the credit market?
So at the minute, unprecedented, I think, is the word. So it's particularly in the unsecured markets. We have seen phenomenal credit card growth at the start of 2024. Almost 1 in 12 adults have taken out a credit card at the start of this year, which is just incredible. And say going back 20 years I've been doing this, I've not seen stats like that in terms of levels of cards. That's also the same in personal loans. We've seen good growth there. We've seen appetite from consumers being met by lenders completely across the risk and affordability spectrum on there as well. And we're also starting to see signs of life in the mortgage market. So some lenders are getting competitive. We've seen a couple of rate price wars, if you like, develop, certainly at the start of the year and again more recently. So this is getting or tempting consumers back into the mortgage space. And we're also seeing a base rate cuts, which again will help to promote and get activity in that market moving as well.
So Craig, we've heard that mortgage rates are starting to decrease. What does that mean from a consumer perspective? What are we expecting to see in the mortgage market?
Yeah, absolutely. So we've seen a huge chunk of customers already roll off their cheap fixed rate deals onto new, more expensive deals, and circa 2/3, 6 million mortgages have already gone down that path, and those people have been through and experiencing higher monthly payments. They've, in the main, been able to absorb those monthly payments. We've seen a little bit of stress in some households, but the majority of those have been able to manage and navigate their way through. There is still a chunk to go off. We're expecting to see 3 million or so mortgages still to go off these cheap deals onto the new higher rate deals, and that's going to happen over the course of the next 12, 18 months that we foresee on there. Now that will bring undoubted stress to some of those households. We're predicting sort of 25% will see a rise of between £300 and £500 in terms of their monthly mortgage payments. That will be larger for those with higher mortgage balances, particularly those in the southeast of the UK where property prices tend to be a bit higher. Now we don't expect this to be anywhere near as much of a mortgage shock as we saw previously. These people have had 18 months, 2 years to prepare for this. People have seen the rates, they'll be able to adjust their household budgets, their household spending, so we think there'll be a huge amount of these households who will be resilient to it. They may have to cut back some of their spend, but we don't expect to see the same stresses that we saw 18, 24 months ago from the early adopters that moved off those rates.
So employment is flat, mortgage rates are going up, consumer demand is increasing. What does this mean for disposable income?
As we just spoke about, there's going to be a huge number of households who've got £300 to £500 increases in their monthly payments. That is undoubtedly going to hit their disposable income. But as just referenced before, we think that a lot of these households will have had time to adjust, they'll have had time to think about how that's going to affect their finances, plan for it, build that surplus into their budgeting so that when it does hit, yes, they won't be able to spend as much, but they will be able to afford their mortgage on there. So we see a minority struggling with that. And the other thing to take into consideration is obviously incomes are still rising. We've got income growth, we think it's 6% year on year. People are still employed, people are still being paid. So that's going to be helping to mitigate some of these additional costs. And as mentioned before, we've also seen some of the other outgoing costs going down. So energy's reduced, we've got inflation that's low as well. So it's going to help build that resilient picture for the households.
So to summarize, we're seeing mortgage rates are falling. Consumer demand for credit is increasing. what does that mean for lenders? What do lenders need to do in this environment?
So the important thing for lenders is to understand not only their existing customers, but also their prospective customers as much as they can. Use all the data assets they have available to them, use all the tools that they have to be able to get the most recent view of those customers, get the most accurate view of those customers. So I'm talking about looking at not just about their financial perspective, but also where do they live, who they are. Know as much as you can so you can make the right decision for that customer, for yourself, and get the right product to market and build that relationship with that customer. We are undoubtedly in a turbulent time. There are increased costs of borrowing, so customers are paying more for their mortgages, for their unsecured credit, but there's also a lot of resilience in there. Incomes are up, incomes are growing, people are employed on there, and there are risks, there are pockets of stress, but these remain identifiable and predictable. If you know your customers and you use the data available to them, you should be able to identify the customers and help those customers along whilst growing sensibly and responsibly.
Thank you, Craig. And for more information and a deeper level of insights, make sure that you read our updated affordability report, which is available now.